Welcome to Market Domination. I'm Julie Hyman, and that's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The Fed has been very clear in the previous months that they don't want to do a stop-start cycle. Their intention is to do easing. We do know that the US economy is slowing. It's not slowing too much. To us, that means that there's still a process of normalization taking away some of that restrictiveness. And so that's a 25 basis point cut in November, another one in December. I think where the uncertainty starts to come in is probably around the middle of next year when we have to wonder, what is that neutral rate? How low are they actually going to go?
It's a very important report because it's a read on the health of the consumer, which is what's supporting this economy. And additionally, if data continue to surprise to the upside in the report, it would go a long way in helping support the narrative of a soft landing, because not only would you see consumers not rolling over, you see them broadening out their spending as well from services into goods.
Morgan Stanley's trading does lean more towards equity trading. That was the biggest source of strength that we saw at all the global investment banks this quarter. We saw upside at all the banks. Within all of that upside, really the equities trading, the standout, and Morgan Stanley doing very well.
We got 1 hour to go until the market close, so let's take a look at the major averages here. The Dow is in the winner's circle today, on track to close on a new record, if indeed it kind of holds up at these levels here. The S&P 500 not quite there for another record, but it is strengthening and has strengthened throughout the day, up 0.4%. The Nasdaq is up about 0.25%. Now, what we've noticed today that's interesting is clearly tech is not leading because the Nasdaq is doing the worst of the major averages, and what's more, the equal weight is outperforming the S&P 500. So that kind of is a hint that things are sort of broadening here. Another hint, we've got small caps that are outperforming by a pretty big margin today, up 1.6%.
And we've had some smart strategists on, Julie, who've been banging the table on small caps. They'll talk valuation. I know others have said they think this is a smart way to play the soft landing environment, if you think that's the smart bet. Have technicians, I know, who've become more bullish on small caps. In fact, one well-known, well-respected technician we have coming up who's going to make that case.
Yes, we're going to talk to him in just a minute, but in the meantime, just to take a bigger survey of what we're seeing in the market here today, not much weakness on the sector level. Utilities, financials, materials are doing the best in today's session. I mentioned those financials, so we should probably go back to the banks here today. Now we have the banks here, but I'm not sure if they are Goldman and Morgan Stanley. Morgan Stanley on this chart here. We talked about the company's earnings. You just heard Alistair Williams talking about the earnings at the company, and the shares are up 6% today.
This was a surge in investment banking. This was an increase in trading. Wealth management was a bright spot. I mean, we've talked about the reports this week, Julie. I mean, broadly, you'd have to say what you saw was really just this rebound for our big banks.
Yes, most definitely, and particularly in those investment banking and trading businesses for many of the banks. And then also just wanted to take a quick look at what we're seeing in the Nasdaq 100 today. I mentioned that tech is not the leader today. However, worth noting, our friends over at Nvidia are seeing a rebound in today's session after yesterday's slump on those ASML, that forecast cut, as well as some more talk about potential sales curbs in certain countries. The shares are coming back today.
Back in the green. What a run for this.
I don't believe that they have made up yesterday's declines. No, they have not. So they're not at a record again, but still a bit of a bounce.
That stock. All right, for more on the latest market moves, let's welcome in Mark Newton, Fundstrat Global Advisors, Managing Director and Global Head of Technical Strategy. Mark, it is always good to have you on the show. Let's start high level here, Mark. The broad gauge, the S&P 500. You look at the charts, Mark. What are they telling you? Is now a good time to buy in?
Hi, Josh. Well, look, the market's been incredibly resilient during normally a very choppy seasonal time where markets historically have gone lower during election years. And so we've managed to really absorb, a lot of this bad news, whether it be because of fear about the election or geopolitical risk increasing overseas, and really has continued to push higher. The intermediate term has improved quite a bit, and I would argue that things are still in great shape between now and next spring, summer. I'm having some concern really about the near term, meaning the period between now and end of year, I don't suspect will be a straight line higher. And that largely has to do with sentiment and also seasonality, along with potentially the start of tech, starting to wane a little bit. And you mentioned that earlier. So when you look at things like the put to call ratio on equities, it's gotten down under 0.5 earlier this week. That's generally not a good sign in the short term for equities. It means investors and or speculators are buying 2 times as many calls per put. You also see other sentiment gauges like AAII, the American Association for Individual Investors, which showed the percentage of bears the last week down at 20%, was the lowest in over a year. So people clearly are paying attention to what's going on. And what's interesting also is that the VIX is also at a very high level, and a lot of that has to do with cross-asset volatility. We've seen the VIX for the last 2 months, it's been over 20. It's the longest run since 2020, and that's really interesting given that what we're seeing overseas, along with the election coming up, is giving investors, generally something to worry about. So how I put this all into perspective is I do think that a lot of investors are hedging for the potential of something bad happening. I don't know that I can say people are truly all that bearish. So I think if anything, they've come to respect the rally. And industrials, discretionary, financials, to your point, with good bank earnings this week, net interest margins, they've come back with a vengeance. I think those are all good things in the intermediate term. I have more of a worry really for the month of November. I think into and after the election, we will start to see some consolidation, but I do suspect it'll be minor, meaning 5 to 7%, probably into the middle part of November.
So as investors, they've maybe benefited from all the gains we've seen, taking out insurance, to your point, in the options market, among other places. But at the same time, we're seeing, at least today, those small caps outperform. And this has been interesting to watch small caps this year because, coming into the year, people were loving the small caps, and they didn't really deliver. And they've sort of delivered in fits and starts. So what happens now?
Yeah, fundamentally, they've certainly been compelling. Our own, co-founder and head of strategy, Tom Lee, loves the small caps and has endorsed IWM from the beginning of this year. Technically, they've starting to get better and better. I mean, today's move puts IWM at the highest level in 3 years. That's a remarkable move that we're seeing with IWM now over 226. So that is quite bullish. I do suspect that means we lift up to 244 eventually. We're also seeing a similar move in the Dow Jones Transportation Average. And for those Dow theory purists, you always want to see transportation eventually follow the move in both utilities and also industrials and push higher. And it's been lagging for 3 years. And now we're seeing those airlines start to come to life. That's certainly a very good sign. So there's no easy way to describe what sector all of a sudden is going to move because of fundamental reasons. A lot of this is just sector rotation. But normally it is right to respect when that happens. And we are seeing a broadening out that is very important, I think, between now and probably the middle part of next year to suggest that the equity market is still in great shape despite some of the near-term warnings that are coming on the horizon.
Let me ask you about some specific names too, Mark. Julie and I were chatting at the top of the show about Nvidia. It's in the green today. It's up about 15% in just the past month. I'm just interested in what you see with Nvidia.
Well, Nvidia has had a nice, sharp, near-term rebound as part of largely a choppy, range-bound triangle pattern that's been intact really since really the summer, June, July. It peaked out, very similar to Apple in that regard. So I think Nvidia likely stalls out right near 140. I don't, potentially 145. I don't see it going to 180 right away. I think there's a great case to be made about why this company and the stock is phenomenal long-term. I just don't see it. I think in general it's going to consolidate in November. That's going to be your buying opportunity. Still great to buy and hold long term here.
I have a little methodology question for you guys at Fundstrat, because you have your sector analysis, and you have it from a fundamental perspective that Tom Lee does, and from a technical perspective that you do. And it stood out to me that there's one sector that you guys are diametrically opposed on, and that's energy, where he says from a fundamental perspective you should be overweight, and you say from a technical perspective you should be underweight. How do you reconcile that internally, and then what does the recommendation end up being for that sector?
Well, we encourage a diversity of opinion when technicals and fundamentals don't always line up. And in this case, the combination of just excessive supply and evidence, I think, that Israel's not going to go after Iranian oil fields. And, the demand picture clearly has taken a hit, I think, because of China Technically, this group moved to almost 2-year lows versus the S&P. For me, that's a big warning sign. My cycles actually go down almost throughout the end of the year, really into next summer. So to say that crude is likely going to go down to potentially $50 or lower, even to the mid-40s. So that should be very welcome news for inflation, also for earnings. But how do we reconcile it? To get back to your original question, look, the firm doesn't necessarily always have to have one view. I think that part of us look at things technically. That's more short-term in focus. Tom has a longer-term fundamental view that's not expected to be, capture every nick and, in terms of every day-to-day move in crude or energy.
Gotcha.
I want to switch gears, get your thoughts on Bitcoin, Mark, because we've been in this range. And so I want to just get your, when you look at the charts, is there an indication to you that we're going to break free of that? And also Bitcoin, famous, Mark, for kind of false breakouts. So how do you kind of think about managing that risk?
Cryptocurrencies, oftentimes, they tend to move very quickly over a period of 15 to 20 days, and then they stall out for a number of months. It can be quite frustrating for investors that come to expect those returns are going to continue. I look at this as being a giant trading range that started back in March. So we're in month 7 or so of that. Getting above 70,000 for me would be the green light that we're going to likely move up to 85 and likely over 100,000. I'm not certain that happens if equities show any sort of consolidation in November. But the charts look in great shape. I mean, Bitcoin was almost 16,000 back in 2022. So it moved up sharply and tripled in price, and it's really gone range bound for a number of months. Whenever a stock or any type of asset moves within the highs of its range bound, 9 times out of 10, you do see an eventual upside breakout. So I think it's going to prove to be very bullish for investors. It's been the top performing asset of the year, right? And so it's still quite positive. But we do need that catalyst. Technically, fundamentals are certainly in place, I would argue. And rates have been pulling back. That's good. A lot of it might depend on the election in terms of what direction whoever's elected and what they see for the SEC and for Gensler. But in general, I think there's reason to be optimistic heading into next year.
Well, I think it's really interesting. You've mentioned November in almost all of your responses, no matter what asset we're talking about. So when you're looking at things from a technical perspective, what do we tend to see around presidential elections? And is that also something that you're sort of drawing lessons from when you're trying to figure out? It seems like November and the election is a big stumbling block for almost everything.
It certainly can be. And so historically, we have seen asset prices stall out in August, September, and actually trend lower throughout October, November, and then bottom at or near the election and start to push higher. And we saw that in 2016 and 2020. I think that this year is sort of an anomaly. We haven't really seen any sort of consolidation thus far. It's moved straight higher. I still think we probably have consolidation ahead. But we really want to see evidence of breaking down. Seasonality is important when price finally confirms the seasonality in some of the cycles. Right now, price is still pushing higher. So it's important to keep that in the back of your mind. But at the same time, you also have to manage risk. And right now, assets we're seeing a broad-based rally. It's just largely not all in technology, which is what investors have come to expect. Since July, it's been a very different tape, and it's been arguably very broad-based, which has been good in a lot of respects.
Mark, good to see you. Thanks for
Likewise,
coming in.
Thank you.
Appreciate it.
Thanks, Josh.
We're just getting started here on Market Domination. Coming up, crude oil prices could go into triple digits next year. At least that is an extreme case, according to one strategist. He'll explain that call straight ahead. Plus, big tech is going nuclear. Amazon joining Alphabet and Microsoft in the shift to nuclear energy with a $500 million investment. We're going to break down what it means later in the hour and also speak to the CEO behind one of the reactor manufacturers. That's at 4 p.m. Stick around, much more Market Domination still to come. oil prices are edging a bit lower today, breaking below $71 a barrel. One strategist says crude oil could reach triple digits in the first quarter of 2025. Joining us now, Eric Lee, Citi Global Energy Strategist. He made the call in a note this week. And Eric, you guys, like many of your peers, model sort of different scenarios, right? So you model a bullish scenario in which oil could go higher, a base case, what you think is most realistic, and a bear case. But this bull case did get some attention, right? $120 a barrel. You raised the forecast for that bull case from 80, so pretty big increase there. What is driving that, and what has changed in your view to fuel that change?
Yeah, well, it's all the geopolitics. As you mentioned again, we're looking at scenarios. We're looking at a bull case. Our base case remains $74 Brent for average in the fourth quarter of this year. But as we're looking at the situation in the Middle East, and we are being careful not to dismiss out of hand the kind of statements that are coming out of Israel and their intentions. So in that scenario, if there is indeed some direct or knock-on effect where oil infrastructure is hit, there are a number of scenarios where this could impact a couple of million barrels a day of Iran's oil production and exports. And in that case, we could be looking at something more akin to what happened to Russia-Ukraine in 2022. But again, this is a bull case, but our base case remains actually slightly lower or close to where we are right now.
Let me ask you, Eric, let's say Israel does attack Iranian's oil infrastructure, Iran gets knocked off. Do you think Saudi Arabia would step in and fill that gap?
So that's been one big part of what's keeping the base case in the market relatively tepid, right? There's a lot of spare capacity in OPEC Plus, somewhere perhaps around 6 million barrels a day. And demand, of course, has faced issues, notably in China, even though we're waiting to see if there's much fiscal stimulus coming out of that. So if there is a major supply disruption, there is a fairly good chance that, if not impacted, Saudi Arabia, the UAE, Kuwait, and others could return some oil to the market. The issue is, again, whether some of the timing of that and just how much of production is lost. But again, this is a very tricky situation, a very binary market, if you will. And that's why, again, we're being tentative on the upside. It's really the kind of thing that calls for upside, optionality. But again, the base case is actually for prices to drift lower, and next year could see $60. Again, very large range for the possible realization of prices.
Well, and Eric, how do you sort of assign probabilities to those various scenarios, right? And do those probabilities shift over time? So is there a way of quantifying like how likely it is that you'll get that bull case versus the bear case?
It's very tricky. It's very tricky. We need to put it out there as a very plausible possibility. The situation for the geopolitics has always been one that is one of a tail risk, right? So even if the probability is relatively low, it is potentially high impact. And so the first thing was to consider, if we see de-escalatory actions, something more like what happened in April, then we should be able to see prices drift back lower and maybe towards the $70 level. And that's really a case where things are really pulled back. In April, Israel attacked Iran. Iran retaliated in a somewhat careful way. Israel counterattacked in another fairly calibrated way. And this was considered by the market as de-escalatory. This time around, if indeed, the US has been urging Israel not to target nuclear and oil-based infrastructure. If that holds, we could see a similar situation here. But again, the rhetoric continues to be quite fiery, and so we want to be cognizant of the possibility that this may still happen.
And Eric, sticking with events, probabilities, of course, the U.S. election just weeks away now. If you believe the polls, it's really a toss-up at this point. I'm just curious, how do you think about that, Eric, depending on who actually moves into the White House and what that means for the oil market?
Yeah, there's a range of possibilities there as well. If there's a Harris administration, it may be fairly status quo. If there is some easing of geopolitics over time, whether it's pushing for a ceasefire in the Middle East, whether there are continued nuclear talks with Iran that could see somewhat of a bearish impulse for oil over time. If it's a Trump 2.0, then it could also be net bearish for oil. There's a number of main issues. The main bearish factor for oil is actually the possibility of trade tariffs and additional trade tensions that could really hit oil demand even more, as well as stimulating U.S. oil production and exports. On the bullish side, there's the possibility that there could be harsher sanctions on Iran. So on whole, we think it's net bearish if there's a second Trump administration.
Obviously, a lot to consider right now. Thanks very much. It's a tough job. We appreciate your analysis. Well, big tech's next bet is going nuclear. Amazon Web Services announcing it's investing over $500 million in nuclear power, signing 3 new agreements to support the development of nuclear energy projects. And of course, this follows on the heels of Google's recent announcement with Kairos, as well as Microsoft's agreement with Constellation to restart the 3 Mile Island reactor, which got a lot of attention. All of this having to do with the huge increases that are expected in power demand related to AI processing.
Yeah, it is remarkable, isn't it? Julie? Just like all of a sudden it feels like every day or every week we're talking more about nuclear.
Yeah.
It's sort of incredible how quickly it sort of took over the radar. But yeah, to your point, I mean, the broader story is big tech embracing nuclear. Obviously, this greater need for electricity to power AI, and at the same time, though, these big tech companies all have these goals, right? Be 24/7 carbon energy neutral, right? So carbon energy free, and so nuclear is a bet they're making. And we were talking off camera, but too, about how is it going to stay just big tech, or do you start to see them kind of this kind of demand evolve as well? Other
Come
sectors
from other places. Right now, the big tech has the resources to spend on this. By the way, the Biden administration has also just announced they were opening grant applications, the call for grant applications for $900 million in funding to develop these small modular reactors that are supposed to be this sort of next step forward for nuclear development. We should mention all this stuff is pretty far in the future. It's not happening this year or next year. It's going to take a few years to get it to happen here. But right now, people are buying the stocks. That's something to mention. There's a company called Oklo that it's getting bid up that is backed by Sam Altman, among others. There's a company called NewScale that is up some 400% this year. It's also heavily shorted, we should mention as well. NewScale is the only company with a small modular reactor design license from the Nuclear Regulatory Commission, but it recently abandoned a project because the costs weren't working out. We're going to talk.
So capital intensive.
It's very capital intensive, even if you're doing the smaller reactors. We're going to talk to Kairos, which is the company that signed the agreement in with Google in the next hour, and it's going to be a really fascinating conversation about all of this.
It's a great chat. All right, looking forward to it. Meanwhile, RBC Capital Markets lowering its rating on Enphase to sector perform. The downgrade comes against the backdrop of a solar sector that we know has seen its share of struggles this year and a surge in nuclear investments from big tech. So how should investors be looking at the solar industry? Joining us now is Chris Dendrinos, analyst at RBC Capital Markets. Chris, it's good to see you. So let's start with this downgrade. You take Enphase to sector perform, so moving to the sidelines. Looks like you cut the target to $100. Chris, just explain this rating change for us.
Yeah, sure. So it's a few facets. I guess the principal thesis behind this is really competitive concerns and then a transition in market dynamics for rooftop solar. And so, sticking with the competitive piece of this first, we're seeing kind of call it very early signs that perhaps Tesla could be taking share in one of Enphase's largest markets, which is California. And what that does is it's kind of twofold. One is that it takes battery share, which is a big growing segment in California. And the second one is it takes share from Enphase's principal product, which is in inverters. And when Tesla's, what they're doing is they're adopting one of their new batteries. It's the Powerwall 3, and that has an inverter and a battery included with it. And so right now with their Powerwall 2, there's a big chunk of that share you actually use Enphase's inverters. So you're losing share there. And then on the market adoption side, we're seeing a transition away from where a homeowner is going to outright own the solar system, and instead they're going to lease it through a company, or they're going to do what's called a power purchase agreement, a PPA. and Enphase is underweight that segment as well. So what we think is, when you add all these kind of concerns up, there's probably some pressure on the outlook for next year. Tesla manufactures in the U.S., and that qualifies them for a domestic content adder, which is a cost savings to the installer or to the homeowner, and Enphase doesn't have that at the moment. So all told, it's a thesis that they're going to see incremental pressure heading into the back half of the year, into next year, and we'd rather be on the sidelines for that situation and watch it play out.
So, Chris, if we zoom out and look beyond Enphase, broaden our scope, talk about the rest of the solar industry, I wonder, given some of the dynamics we were just talking about with nuclear, that there's this huge demand from the AI companies for what they view as clean energy, and that includes nuclear, but it also includes solar. Do you want to be invested in companies that are maybe more weighted towards corporate development, bigger solar farms, or those that service some of these AI companies?
Yeah, no, and I think that's a great question, and it's been our call all year long that we prefer the utility scale developers. And I think when you look at that market, it's had its own challenges. Given I guess the biggest challenge within the utility segment right now is there's a very long interconnection backlog. So people want to develop the solar, they want to develop the renewables, but they can't because they can't get the connections with the utility. That's caused project delays for everybody across the industry year to date, and it continues to be a headwind. And if you look at some of the forecasts from third parties, they'll continue to tell you that utility scale solar could be flat for a number of years on the demand side because you cannot get those connections, or there's limited amounts of labor that are available to help you develop. So we still favor that sector. We think that the demand is extremely strong, and it will remain strong. Whereas on the residential side, there's been demand pressure as a result of higher interest rates and some of the regulatory changes that have made it more expensive.
Chris, I'm just curious, given your coverage universe, how are you thinking about potential election risk?
Yeah, it's interesting, and I think our position on it is that a Democrat in the White House is definitely favored, but there are certain aspects of a Republican presidency that we think could be an opportunity for certain companies, and the name that I would call out here is for solar, where they're a domestic manufacturer of U.S. solar panels. They're really basically the only one at utility scale that's doing that. And if you have a Trump White House or Republican White House where they're more aggressive on tariff policy and U.S. protectionist policies, that favors for solar, and they could block everyone else out. They could put in place larger tariffs on imports, and for solar, that's an opportunity to take a lot of market share, solidify their position, and potentially push prices higher if they so choose. And so we really like the dynamics for them from that position.
Interesting stuff. Thank you so much, Chris. Appreciate it.
Thank you.
We're going to continue the conversation about what's going on in the power industry. On Friday, we'll be talking about Texas Solar with ERCOT CEO and President Pablo Vegas at 4:15 p.m. Eastern. Not just about solar, but just about the grid in Texas generally, which has been taxed at various times. Should be a fascinating conversation.
And coming up, Novavax shares sinking today after U.S. regulators placed a hold on the development of its experimental flu vaccines. We'll check in on some of our top trending tickers on the other side. Stay tuned. Much more market domination still to come.
Now, time for some of today's trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, we got to talk about Novavax because that stock is down 19% today after U.S. regulators placed a hold on the development of its experimental combination COVID flu vaccine and standalone flu vaccine. This is coming after a severe adverse event that occurred in a single clinical trial participant. He reported nerve damage, that's according to the company. Novavax's chief medical officer says they're working closely with the FDA to resolve that clinical hold, but this seeming to be a blow, even though it's not clear why this happened to this particular individual. And again, it's just one person in the study, but nonetheless, obviously the FDA was concerned enough to put a hold on it.
Yeah, the company did say, it is working with US FDA to resolve this clinical hold. Company saying it does not believe causality has been established for this event. Stock is down today. We should also note, though, you pull back the chart, and this one has been a rocket ship in 2024. It's up more than 100%.
Yes, a rocket ship in 2024.
Yeah.
That is such an important qualifier because if you look at a 5-year chart of this thing.
Yeah, we just had the chart up. It's remarkable.
It was, obviously it hit its peak during the pandemic on the hopes that it was going to be not sure what happened with that chart, but the point is it hit a high of about $320 almost. Because there was hopes that this was going to be another viable alternative, but they sort of came too late to the market to really do that. There you have the 5-year chart. So it's down a lot since then.
Next trending ticker, check out Intel. That stock is lower on the day after the chipmaker announced it would be laying off roughly 1,300 employees, as well as news out of China that a cybersecurity group is calling for checks to be conducted on the company's products, claiming a high rate of failure. So down about 1.5%. There was also an interesting piece, Qualcomm likely to wait until after the election here before deciding whether to pursue an offer to buy Intel. This is per Bloomberg, citing sources apparently kind of understandably would want more clarity on who exactly is moving into the White House.
Right. I mean, listen, if it's a day ending in Y, there's some negative news on Intel, it feels like. Intel it's just been under sort of this barrage of negative sentiment. The stock is down more than 50% year to date. And so, it looks like that people aren't really looking for reasons to get in here, even with the big declines that we have seen in Intel shares already.
Well, I thought we had a really interesting conversation with Bernstein's Stacey Rasgon this week about Intel. And we asked Stacey, does Gelsinger have the right strategy in place? And I thought Stacey's point was really interesting, but it doesn't even really matter if you believe in the vision or the strategy because his core business no longer supports that vision, even if you believed in it. It was interesting.
Yeah.
Stacey's always interesting.
Yes,
On Tuesday, Penguin Solutions is completing its brand transition from Smart Global Holdings. The company designs, builds, deploys, and manages next-generation enterprise infrastructure for AI and beyond. It also reported earnings, which came in below analyst expectations, and the stock is sliding on that news. And joining us now is Mark Adams, Penguin Solutions CEO. Mark, it is good to see you. Let's start off on the earnings, Mark, as you reported. Obviously, investors are disappointed with those results, but walk me through the quarter, Mark. What is driving the business?
Well, as you talked about the transformation into Penguin, we continue to build out our existing and new customers in AI infrastructure deployment. That being said, we've talked about this on prior discussions. Our business can be lumpy at times, and deployments can be billed in month 3 or might roll into the next quarter or two, and that's just the nature of the large-scale infrastructure deployments. So what I would say is, overall, we're in guidance, slightly below the midpoint, but continue to be very bullish on the business. We also put together a full-year guide that is somewhere in the nature of 15% growth year over year, and at a gross margin that's up from where we joined the business a few years back. The gross margin's over 32% for the company. So still remain very positive despite some of the early reaction out of the gates from our earnings.
So if there's, this lumpiness that you described, Mark, that kind of implies there's a dip and then there's a hump, I guess. When is the uptick coming? Do you have any sort of clarity and visibility into that uptick?
Yeah, I think we implied in our growth projections for fiscal year 25, and we're on a end of August fiscal year. So we're in our first quarter. Implied in that growth projection is that we're going to see the uptick here in 25. And we've got some really good opportunities and good bookings that have already come in so far in the year. And we look forward to building off that. It's our business is different than the traditional OEM systems company. I think sometimes that gets lost on our investors. And what's different about it is we kind of lead with a services and software approach, and the systems kind of follow in our sales motion. We help our customers design the systems. We then build them for them and then deploy them with our both of our systems expertise, but our management software and management services. And that integrated approach is what drives our margins significantly higher than our competitors. Now, we don't sell hardware sideways for low margin. That's not our business model. And so when we put 15% growth up there, it's 15% growth at higher margins than the industry average. And so that's why we remain so bullish that fiscal year 25 can be a great year for us.
You know, you mentioned those competitors, Mark. Let's talk about that competitive landscape. Names like Dell, HPE. I'm just curious, Mark, get your take on the general competitive environment and whether it's shifted at all since the last time we spoke.
You know, not really in the customer's eyes yet, although, you know, of late, we've won 2 large transactions for ourselves where we've gone into environments where customers actually bought hardware expecting some of these systems companies to manage the deployment for them. And they called in Penguin to actually rescue a failing implementation because of the complexity that we manage. This complexity can be in the form of networking or GPU reliability or cluster performance, cooling systems, networking likes. And so when you think about our business model, I think that it's different. And I'm not saying it's better or worse. Of course, the companies you named are very strong OEM systems providers, but they also operate in a different value proposition and thus a much lower gross margin than we do at Penguin.
And so it would seem here, in theory, that the market opportunity is big because it seems like there would be more examples of the kind of thing that you're talking about. And we certainly know that there are a lot of implementations that are happening, whether it's you guys doing it or your competitors. Sure. So I guess my question would be, even given the lumpiness argument, which I get, why we're not seeing more growth coming from Penguin at this point, Mark?
Well, as I said earlier, this is really a transformation. If you look back 4 years ago, we were a memory module company, and the company had acquired Penguin, but Penguin was operating at about 15% gross margin. Today, that's north of our company average at 32. And we're investing to scale out our business as we speak, as the transformation continues. Part of that transformation was the sale of a consumer business, a consumer memory business in Brazil. And we're redirecting more and more of our resources towards scaling and growing the business. But that's kind of where we are in the evolution of the company. We added a big customer in Q3, we mentioned. We had another big customer yesterday, we mentioned on our earnings call. One of the world's largest consumer gaming companies was a multi-million-dollar contract for our software services and Origin AI product portfolio. And I think it's just the evolution of our company and the fact that deployments will increase. We like our growth potential.
Mark, you can always come and talk with us whether the stock's in the green or the red, and we appreciate it. Thank you.
Thank you.
Coming up, Cisco shares higher today on the back of a bullish analyst note. We're going to take a look at some of the top calls of the day when market domination returns. Time now for some calls of the day. Citi upgrading Cisco from neutral to buy. The note saying a rising AI tide lifts all boats. So Citi now likes this one. Talking AI, they say, while AI is currently a small piece of the business, we see the potential for a stronger contribution. And of course, they like to look at valuation as well.
Yeah, in particular, they're looking at the Ethernet AI possibility, the total addressable market there. And that's what they think that Cisco has the ability to do here, that the Ethernet can get a high 40% in that range share of AI switching this year, or I should say next year. They thought it was low 40s. Now they think it's high 40s that Cisco's going to capture that market share.
Yeah, they did call out downside risk to their clients. They mentioned intensifying competitive pressure. They mentioned weaker economic spending environment, M&A related integration headwinds, but that, of course, clearly not their base case here.
Yeah, and the stock's up about 11% this year, so it's not been a huge gain, and in fact has underperformed the S&P 500. Well, TD Cowen is upgrading Universal Health Services from hold to buy. The note there highlighting upside from medical payments in particular. And this one caught our eye because we have seen a lot of activity in the medical market this week. We had United Healthcare, the giant health insurer, yesterday coming out with results that missed estimates because of medical costs going up. The hospitals yesterday, including Universal, rose. It's so interesting to see this note here today. The analyst saying that future EBITDA upside is underappreciated by investors, in particular the contribution from Medicaid state-directed payment program.
Yeah, stocks already had a nice run here, Julie, year to date, but they're piling in. I clearly see better times ahead for this one. I'm just looking for the average. The target here, they go to
283.
283. Average target's about 245. And earnings coming up, by the way.
Bullish.
October 24th. Circle the date.
Yes. Let us talk about another ticker that has been trending almost on a daily basis here. We're talking about Trump Media, DJT, taking investors on a wild roller coaster ride. The stock is back in the green after being briefly halted yesterday for volatility. But DJT, being known for its meme-like moves, has an appetizing appeal for options traders. We're breaking it all down with explosiveoptions.net chief options strategist Bob Lang in this options pit sponsored by Tasty Trade. Bob, we wanted to talk to you about DJT because we know there's a lot of options activity. I mean, there's a lot of activity, period, on this name, but a lot of it is through options. What have you been seeing on this name, and what sort of stands out to you?
Well, great to be with you, Julie and Josh. What really sticks out to me is the high implied volatility. And this high implied volatility for a stock trading at about $29, $30 a share means that a high implied volatility of, say, 300%, which is what it's currently sporting right now, means the stock can move up $12 or down $12. So that's a huge move, almost 40% of the price of the stock up or down. So if you're an options player, you love that sort of volatility. You want to be involved in a name like this because there could be a huge payout if you hit a home run, if the stock moves in the direction that you're looking for it to go into.
Bob, the flow for DJT, bullish, bearish, what are you seeing?
Bullish, Josh, and I think that certainly with the with that, combined with that applied volatility, with the stock outstanding, it can really push the stock up in a big way. We saw that happen early on when the SPAC was converted into DJT earlier this year, and the stock I think went up to like $60, $70 in really a very short period of time. So I think that because of the float, Josh, it can really fuel a big, huge squeeze to the upside.
How do people, though, manage risk with a name like this that is so volatile? I mean, it could squeeze to the upside, but we've seen it fall to the downside, too. And certainly one of the risks is if Trump does not win election, then, and this has been a proxy, that the stock could go down. So, when you're talking about something like this that has that wide dispersion of possible outcomes through options, how should people think about managing that?
Well, the beauty about options, Julie, is that it's defined risk, right? So even though the stock can move in a big way, not just every week, but even every day, you can define your risk by just saying, I'm going to buy a call or buy a put, and that is all I can lose, period, regardless of what direction the stock goes into. So if you're wrong and you pick you buy a put and you're picking the stock to go down and it ends up going up, you pretty much just defined your risk. Now, if you hold a stock, what a great way to mitigate your risk from the high volatility is to sell options against your stock. Let's say you own 500 shares of DJT and you're worried that the stock could go down. You can sell some upside calls. And with that high implied volatility, Julie, you're able to get a lot of premium. If you go out, say, 2-3 months, you can probably pick up a large chunk of premium by selling against the stock that you hold. This is what's called a plain vanilla covered call strategy. So I think that is a way to certainly reduce some of the risk involved in the stock.
Bob, the election only a few weeks out now. Any attractive election plays you would call out? Let's say Trump moves back into the White House. What do you do?
Well, there's been a huge call by some of these crypto investors here, and they've been plowing a lot of money into Trump's campaign, into the coffers over there. So I think they're looking for some upside if Donald Trump does win this here. So I think Bitcoin might be something to take a look at. But of course, if Kamala Harris comes in, I think there are several areas that could work real nicely. I think primarily the home builders. I think they're going to do extremely well. We're talking about names like Pulte Homes, Toll Brothers, Lennar, D.R. Horton. I think these stocks are going to do well because she has a plan to start building more homes for middle class and even lower class citizens who are needing to get into the homes because home prices have gone up extraordinarily high over the past 3.5-4 years, and it's become really unaffordable for some people to get into a home. So I think that these groups are going to do extremely well. There's some others like healthcare I think that are going to do well under Kamala Harris too, but primarily home building.
Bob, thanks a lot. Appreciate it.
Great to be with both of you.
General Motors is upping the ante on its EV bet, investing $625 million directly into a U.S.-based lithium mine project. Joining us now, Yahoo Finance's Pras Subramanian. And it's interesting here because we've been talking so much, Pras, about EV demand kind of waning, but obviously they still want to get supplies for the batteries they're putting in these cars.
Yeah, it's a bet on what they think is the future of EVs is going to happen eventually, and they need to actually start developing or insourcing these materials in this country because Chinese materials will be sort of unfavored based on sort of tax treatments and things like that. So yeah, $625 million with Lithium Americas for this Nevada Thacker Pass development, is what it's called. And then also GM is going to put up $195 million in a line of credit, which then unlocks $2.3 billion in DOE loans to further develop this massive site. So yeah, this is going to be a site that's going to build lithium for almost 40 years, right? So this is a long-term bet here. GM showing it's still serious about this, even though it's sort of pulled back down its guidance for how many EVs it's going to make this year. That's going to be 200,000 is the goal now. So GM seeing some near-term sort of, like you said, demand issues with EVs, but they don't see that happening for the long term, and they're going to have a bunch of new EVs out this back half of the year, including some cars that are around $35,000 to $40,000.
Is it fair to say, I mean, if you look at that sector, that GM is kind of continuing to push forward, even as maybe some competitors don't push forward as aggressively or even pull back?
Yeah, it looks like a big number, but it is a careful move here by GM. It's a long-term bet. But you mentioned, you talk about Ford, right? They really retracted back from what they were going to have with very audacious plans. Now they're saying, you know what, we're going to make smaller EVs. We're going to hold back development on some of our factories. We're going to delay some of those launches. So you're really seeing, even Volkswagen, you're really seeing these other big automakers. Toyota famously didn't do this. They're slowly doing it because hey, we had the right move with hybrid. So I think it's interesting that GM is actually still pushing forward, albeit not as aggressively, but still pushing forward with getting these materials in-house, in-sourced in this country because of the fact that from China, they're not going to be taxed very badly.
Right. And still, though, I believe Thacker Pass doesn't produce any lithium now.
Not yet, yeah.
They're still working on it, so we'll see how it goes. Thanks.
All right, Bras, thank you. Appreciate it. While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session, and let's start with where the major averages ended the day. The Dow closing at a record here today, 43,077, up 337 points, up about 0.75%. And this was also the leading of the three major averages, in part because some of these earnings reports that we've been getting here, no real macro narrative necessarily driving things today, but definitely some individual names getting some attention. The S&P 500 up 0.5%, so we're covering some of yesterday's losses, but not enough to push it to a new record. And the Nasdaq up about 0.25%. Now, as we've been talking about today as well, we see the rally broadening, which again is implied by the fact that the Dow outperformed the Nasdaq Composite. The Russell 2000 getting some attention here, up 1.7%. We talked earlier with Mark Newton over at Fundstrat, who says he still expects small caps, that this is sort of a breakout for small caps, and equal weight S&P 500 also doing better than the underlying 500 in today's session. Jared's got a closer look at what went on today as well. Hi, Jared.
That's right, Julia. I think it was a record for the S&P 500 equal weight as well. And we got a couple of sectors there. But I just wanted to reiterate, Russell 2000 looking like it wants to break out yet again. We've seen this many times before. Here's a 5-year chart just to show you. It's right up against some price memory right here. 2250 is kind of around the center. It's at 2288. We'll see if this time sticks and it actually gains some momentum. I'm going to talk about the VIX in about 30 minutes with Josh. Just kind of noting here, it's below 20. That's significant. We also have the 10-year T-note. It was kind of hovering around the 4.0% level, and we've seen that in play here. This is a 5-year chart. Let me just bring that down to a 3-month, and we can see what it's been doing there. There we go. So right around the 4% level, that's significant as well. But I promised some sector highs here, and we saw that in utilities and financials. Those were at records. Also, some of the leaders here, throw in real estate, and we've got an interesting mix. Going to talk about that as well. Communication services and staples both traded to the downside, but only marginally. And if we take a look at the leaderboard here, small caps, that's IWM. That was in the forefront. K-Web, China coming back. It's had a few stumbles over the last week or so. We can take a look at that in a second. What was not working today was software and New York FANG. And software has been flying recently, so giving back some of those gains. And then China, we'll take a look at that. Here's China, kind of a mixed board today. Let me just show you the last 10 days so I can see you, so you can see how much downside action they've been facing. But then you put a month chart on a month time frame to all of these, and they're solidly in the green. All this just means that they're experiencing incredible volatility. And also wanted to check in on unprofitable tech. That's what we see in the ARC innovation component. So Tesla having a negative day, Roblox is well down 10%, but for the most part, well, that was over the last month, sorry. Let's check out that. We're seeing more green than red, led by Bitcoin and Coinbase, up 7.2%. Josh?
All right, thank you, Jared. Stock staging a comeback as the Dow closes at a fresh record. And our next guest sees volatility on the horizon, driven by uncertainty, especially the election. But there is an opportunity because of that volatility. Joining us now is Christy Akulian, BlackRock head of iShares Investment Strategy Americas. Christy, it's good to see you. You know, Christy, I bet some viewers are watching this right now and they think, why not just keep it simple? You know, economy's decent, earnings are decent, the Fed is cutting, stay long. What do you make of that?
I don't disagree. And thanks for having me as well. So, you know, I think that the big picture of what we're seeing right now is that the U.S. economy is stronger than we expected. So we are constructive on risk assets. We are still constructive on U.S. equities. I think that what we think that now is the time for is really sort of getting ahead of some of that rotation. You talked about the broadening out of the equity market. We think that that can continue next year. So I think the story is definitely about staying invested during volatility, but just being a little bit more specific in terms of where you're allocating to. So it's not necessarily just going to be last year's and the first half of this year's winners that are going to win going forward. We see more opportunity outside of kind of the mega cap names and maybe out of the technology and the growth sphere as well.
So Christy, where specifically then do you think people should be looking?
Yeah, so, you know, we've been talking about this as a moment to rotate out of mega caps and into large caps, not a moment to move from large caps into small caps. We're still a little bit hesitant there. I think in particular, we see opportunity in some large cap value names. So something like BLCV is a good example. I think that investors are really overweight growth right now, even in just some of the broad-based indices, and because of the really strong performance that we've seen recently. So being a little bit more deliberate about your value growth balance with a little bit more eye to valuations, I think makes a lot of sense right now.
Christy, why the caution on small caps? I ask because we've had any number of strategists come on the show. They bang the table on small caps, Christy. You know, they say valuation's attractive. They think it's a really smart way to play the soft landing. We even had technicians. We had Mark Newton from FundStrat. He looks at the charts. He's getting more and more bullish on small caps. So why the kind of caution there?
Yeah, absolutely. I think part of it's just a time horizon. Like, look, we love IWM. IWM is the small cap utility ETF in the space, and we see investors use it in so many different ways. There's a huge options market around it. Investors can use it to get long or short. I think that the small cap play makes sense on a really tactical horizon. I think where we're a little bit more skeptical is the durability of a small cap rally. So even though we say the Fed is cutting interest rates, they're still high. And even though economic growth is positive, it's still slowing. And I think the combination of those two things is what makes us a little bit nervous about allocating to small caps for the long term. But you're absolutely right. We can see some really sharp rallies. And I think, IWM is a great way to play that for those who want to. Just for longer term portfolio construction and as we're thinking about the future, I think we still like to be a little bit more up in quality, just given some of the slowdown that we expect to see in the economy.
Christy, speaking of long-term themes, I want to ask you about AI and how that's playing out as well. There was an interesting piece in the Wall Street Journal today looking at just the enormous amount of spending that we are seeing the so-called hyperscalers do, right? Looking at their sort of CapEx, and that it's still expected to climb even further. At the same time, a lot of that spending is benefiting one company or a small number of companies, and the returns on that investment are not yet entirely clear. So at this stage in the AI story, where should investors be deploying?
Yeah, and I guess I'll start by saying that we're believers in the AI trade, right? Like we believe that this is going to continue to reshape the economy and impact the bottom lines of a lot of companies that are outside of the tech sector as well. So I think it's fair to take a little bit of pause and look at valuations from here. In the same way that we're looking at the market broadening out, we're looking at the AI trade broadening out too. So something that we've been talking about since the mid-year, I know you highlighted it as one of the top performers and kind of hitting an all-time high, but we like utilities as another way to play. We like data centers as another way to kind of get ahead of where that AI trade is going next, not just where it's been really successful so far.
And finally, Christy, what about gold here? One of the strongest performing commodities this year. What are your thoughts on the metal?
Yeah, I mean, obviously really strong performer this year. I think one of the most important points is just that investors are really using it as a hedge and as a diversifier in their portfolios. We've seen stock bond correlation be positive for such a long time that investors had to reach for alternatives. I think gold has really benefited from a lot of that. I will say, we do see stock bond correlation turning back negative, which is a really good thing for portfolio construction and for investors everywhere. So we see opportunity in yielding assets as well. We really like income as a theme and as a diversifier for equities too. So something like BINC is instead. But still see a role for gold, still has a small part in our portfolio.
Christy, thank you. Appreciate it.
Thanks for having me.
A few months ago, a headline read, "Critics say Elon Musk has revealed himself as a conservative. It's not so simple." Turns out, it was indeed that simple. Tesla CEO spoke at a Pennsylvania rally with former President Trump, and according to new government filings, he has been pouring a lot of money, $75 million, into his super PAC backing Trump's campaign in the last quarter alone. Joining us with more Yahoo Finance's Ben Werschel, who dug through the filings to get the numbers here. So what stood out to you, Ben, in your reporting?
Yeah, so Musk is the big headline of this. It's one of the big final deadlines before Election Day for these types of campaign finance filings, and Musk gave a total of $75 million over the quarter. His first donation came on July 3rd, so 3 days into the quarter, and then it continued month after month. So it's 75 million over this month, up until the beginning of this month. And what's also notable is that he has kind of wholly taken over this organization. It's called America PAC. He is the only donor to this group, and it's a group focused on the ground game, especially in Pennsylvania. What Musk also announced overnight was that he's going to be in Pennsylvania for the next 5 or so days to give a series of talks. So he's kind of doing the ground game. He's funding the ground game, and he's also trying to bring out the voters them himself. So it's just the latest indication of how all in he is on this campaign. You mentioned the rally in Butler that he appeared at as well. A couple other interesting details that we learned today. Musk is far from the only a billionaire involved in this. Miriam Adelson, the widow of Sheldon Adelson, gave a bunch of money, $95 million. Richard Uihlein, who made his fortune in boxes and packing, gave another 50 million. So it's a kind of another indication of these all billionaires getting behind Trump and kind of giving a big stretch. It's not to say that Kamala Harris is slouching. Her big money pack raised $633 million in this stretch as well. So this is a lot of big names behind it. Ari Emanuel, Melinda Gates, Lauren Powell Jobs, Tyler Perry, folks like that show up on that listing that are giving on that side. So it's a whole lot of money sloshing around the campaign right now for sure.
It's so much money, Ben, that I don't know if you saw this. There was this interesting New York Times article and it talked about how Harris, for example, has raised $1 billion, and now actually, I don't know if you saw that piece, but some donors occasionally reluctant actually to give more, and you start wondering, with all this money sloshing around, does it have actually some unintended consequences in that respect?
For sure. I mean, it's a kind of a question, especially this year, of like, how many TV ads can you buy? How many ads can you buy in the Philadelphia market? It's already saturated. When you go there, it's just every ad is a political ad. The one area where there is a little bit of a shortage, interestingly, is the kind of formal Trump campaign itself. Obviously, these supporting groups, these Elon Musk groups, are very well funded, but the Trump campaign itself, and this is pretty unusual, the candidate is still raising money. He's still doing fundraisers in between his rallies, which you don't see. Kamala Harris has said she's done raising any money between now. So he's got a little bit to raise for the formal campaign. So that's one area where it's not. But to the larger point here, it's billions and billions of dollars stretching around, starting with the Kamala Harris $1 billion you mentioned.
And Ben, just curious, in sort of the modern election era in particular, does the candidate with the biggest war chest historically win?
Not necessarily. No, Trump had a sort of smaller war chest and won in years past. What the other thing that's interesting about this is that with the smaller Trump campaign right now, he's outsourcing a lot of his stuff to Elon Musk. So the Trump campaign ground game, so to speak, in Pennsylvania is essentially this Musk organization. So it'll raise a lot of questions about how well that's going to work. So if he wins Pennsylvania, if he loses Pennsylvania, it kind of will raise a whole lot of questions after November 5th in terms of whether this was a good idea.
Ben, thank you as always. Appreciate it.
Good to see you.
Coming up, big tech is going nuclear. Google and Amazon both spending big to purchase nuclear energy from multiple small modular reactors that, by the way, aren't even built yet. We're going to speak to the CEO of one of those companies behind the development of the reactors on the other side. Stick around, more market domination overtime is coming up. Tech companies are piling into the push for nuclear power. Amazon just announcing 3 new agreements to support the development of nuclear energy projects. And it follows a major announcement from Google, that company recently signing the world's first corporate agreement to purchase nuclear energy from multiple small modular reactors. Behind the development of those reactors is Kairos Power. Mike Laufer is here. He's the CEO of that company. Mike, thank you so much for being here. We have just seen a flood of these announcements recently. First of all, for people who are not familiar with small modular reactors, can you describe to us really the key difference between them and their development and sort of what we've traditionally seen in nuclear power?
Sure, Julie, thanks for having me. So small reactors, they have a lot of potential, a lot of promise, and they're really different from the large conventional reactors that we've built. One of the key things that's appealing is that their smaller size makes them more tractable as construction projects. The hope that they can demonstrate reliability for delivering on cost and on schedule. That's been elusive of the large builds. And then also the smaller size provides a number of opportunities. It increases the safety and gives more flexibility for siting. So these are a number of reasons why they're proving to be quite attractive right now.
Mike, in terms of the timeline here, and I want to make sure I have this right, you plan to deliver the reactors between around 2030 and 2035. Why, Mike, is it that many years out? Is it just because it takes that long to get this permitted, approved by regulators?
Sure. There are a number of reasons that kind of drive the schedule here. I think what's significant about this agreement between Google and Kairos Power is it really lays the path to that long-term commitment. It's the first corporate agreement for multiple reactor deployments, and that target of 500 megawatts by 2035 is really it really builds on the iterative process that Kairos is employing to do our first technology demonstrations, where we're doing non-nuclear demonstrations first. The technology is complex. It takes a significant amount of time to develop it. And then there is the regulatory part of it. And in that aspect, we've been at the lead. We have a construction permit for a smaller test reactor in Oak Ridge, Tennessee. And that kind of, building on that is kind of what allows us to do the scale for all the commercial deployment that this agreement really kind of sets in place.
Well, and to be clear, Mike, you guys are not the only ones who it's going to take years. There are no SMRs in use right now yet, right? They're all in development at this point. What is sort of, I mean, if you can describe it maybe in layperson's terms, what are sort of the biggest technological obstacles? Like, what do you still need to figure out before you can get these guys up and running even on a demonstration basis?
Sure. So there are 2 areas where the challenges come in. One is on kind of the operations side, and in that respect, Kairos is taking kind of a novel approach. We're really leveraging kind of the our system has a very high level of intrinsic safety characteristics, which is important for the technology selection, and we're using that to pursue basically non-nuclear full-scale demonstrations of the technology. We've gone through one complete iteration. We're taking that down right now, and we'll be building a second one of those facilities at our campus in Albuquerque, New Mexico. Gaining that operational experience is kind of a major hurdle for customers to understand that this technology is going to work and how it's going to work and that it's going to be reliable. And so we've been focused on kind of overcoming that. The other one is kind of the conventional problems for large scale projects. They're twofold around cost. One is that the costs are high, which in itself may not be prohibitive, but it's the uncertainty around those costs, which means that in many cases, kind of new projects for large nuclear builds are just too risky and there's too much capital at stake here. And so for us, trying to work through small iterations, gain that cost certainty through smaller tests and actually building it, because we're doing a lot of in-house manufacturing ourselves, it provides kind of a novel way of providing that cost certainty, which has been really very elusive in the space.
You know, Mike, we've seen now big tech clearly embracing nuclear, and they've got the very deep pockets to do it. I'm curious whether you think other sectors will be equally enthusiastic and have the means to embrace nuclear in the same way.
So I think that kind of the need for power, particularly for data centers, has kind of changed the dynamic really in the last year to year and a half from where it was. it's kind of changed the landscape for energy. We've kind of gone from kind of a stagnant, stagnant growth to really kind of needing a lot of new capacity. And the lead here, this is where there's high demand right now, and so it's not surprising that we're seeing first movers in this space. But there's no need, and there's no shortage of need here, and so the demands for decarbonization are really broad and so large that there's lots of opportunities in the space here.
And Mike, I'm curious, lastly, how long you had been talking with Google, and if you're currently in talks with other tech companies or non-tech companies, or if you're sort of concentrating all of your efforts now with that first partner.
So Kairos has a very broad, we are a mission-driven company, and achieving that mission to really fulfill the potential for nuclear and the role that it can play in decarbonization is central to the company. What's really important about this agreement is that Google is not just a customer, but they're really an important partner. And kind of through the process to reach this agreement, they've been reviewing Kairos, learning about our technology, but I'd say more importantly, they've been learning about our development approach and kind of building confidence that this is an approach that is different in many ways that are important compared to other efforts to develop nuclear technology. But for us, it really is a partnership and understanding kind of how we're going to transition from where we are in the development and demonstration phase and work with them through the early deployment of the first fleet of reactors. That partnership is really exciting, and we're really excited to partner with Google on that.
Mike, great to have you on the show today. Thanks so much for joining us.
Thanks so much for having me.
Netflix is set to report third quarter earnings on Thursday after the bell, but the streamer will once again have a high bar to overcome as the stock trades near all-time highs here. And analysts look ahead to another price hike announcement as a potential catalyst. Joining us now with more is Yahoo Finance's Alexandra Canal. Allie.
Hello. Yes, and we are seeing the stock trade at the upper end of its 52-week range. It's up around 45% since the start of the year. And analysts say there's a potential for more room to run with a possible price hike on the table. Netflix last raised the price of its standard plan in January 2022, upping the monthly cost to $15.49 from the prior $13.99. It also raised the price of its premium tier by $2 to $19.99 before again raising the cost of that plan last October, and we're now looking at a price point of $22.99. So far, we've been spared from any more increases this year, although the company has yet to raise the price of its ad-supported tier, which remains one of the cheapest ad plans on the market at a price point of $6.99 a month. Now, Citi analyst Jason Bazinet, he said in a new note to clients that the low cost per viewed hour at Netflix suggests the company will raise U.S. prices by 12% in 2025. He did warn, though, that although that'll be a boost to the stock in the near term, shares could ultimately fall in the long run as expectations that the company will deliver full year 2025 earnings of $25 a share likely won't materialize. Now, for full year 2024, analysts polled by Bloomberg expect earnings to hit around $19 a share in 2025. That estimate is pegged at just under 23. So the expectations are really high for this company. In the current quarter, we're expected to see a revenue surge 14% year over year, earnings up around 40% year over year. So it's this notion that as the company keeps expanding into live events, as it ventures into sports, as it gets more comfortable with its ad tier, that we're going to see that trickle through in the top line as well.
Interesting. What about like blockbusters right now, hits right now? What are we hearing about are really going to deliver for them?
Yeah, look, they've been really focused on different types of content, right? Not just your standard series. Right. They are embracing more documentaries. Like I mentioned sports, they're doing the double Christmas game for Netflix. And the main thing here is the company wants to really boost engagement on the platform at large. They want people to be spending a lot of time there. How do you do that? You have to really cater to all types of audiences. Now, I will say, if we take a look at churn levels, which is the rate of cancellations, Netflix has the lowest churn on the market. So, when it comes to people wanting to skip other streaming services, they're not skipping Netflix. And there's a reason for that. And it's because of the content. It's because of the investments. It's also the fact that they're licensing more content. And there's this new normal that's been circulated around Hollywood when it comes to the fact that we're seeing studios embrace licensing more. Suits, that was one of the top programs on Netflix. So all of that is just driving viewership on the platform, therefore subscribers, therefore the ad tier. It's this trickle through effect that investors are watching.
All right, we'll be watching, Allie. Thank you. Appreciate it. Time now for What to Watch Thursday, October 17th, sponsored by Tasty Trade. Starting off on the economy, monthly U.S. retail sales numbers are out at 8:30 a.m. Eastern Time. Economists forecasting sales to grow 0.3% in September, giving us some more insight into the health of the consumer.
We'll also get a read on the housing sector. We'll be getting new home builder confidence data for October in the morning. That number expected to tick up to 42 compared to the prior month. And speaking of housing, weekly mortgage rates from Freddie Mac, they're out at 12 p.m. Eastern. Rates jumped for the second week in a row last week. Potential homebuyers hoping the Fed's rate cut will start to alleviate some of the pressure on mortgage rates going forward.
And on the earnings front, earnings season continues with a big batch of reports, including Netflix, Taiwan Semiconductor, and Alaska Air Group. Netflix announcing third quarter results after the closing bell. Analysts expecting the company to get a lift from new content and higher prices.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The Dow closing at a record high as stocks make a comeback from Tuesday's decline, but it wasn't tech that was the big winner on the day. Driving the gains were financials on the back of earnings. We've got the trading day takeaways, plus the cyber threat facing consumers, corporate America, and the election. We're diving into a new report breaking down the biggest risks straight ahead, and the changing landscape of healthcare in America. We've got the CEO of one company trying to address the strains on the system. Arctic Wolf releasing its new human risk report today, the survey analyzing cybersecurity risks within companies. But what other threats are out there? Well, joining us now for a full view of the cybersecurity landscape is Arctic Wolf CEO Nick Schneider. Nick, it is great to have you back on the show. I want to start high level, Nick. Always interested to get your thoughts on this because you have an economy that seems to be in decent shape. Against that economy, against that macro, Nick, how does spending on security just kind of generally look to you right now?
Yeah, I think cybersecurity is one of those industries or trends in the marketplace that will continue to get a lot of attention, both in the public markets, but also within individual organizations. So I see increasing spend, ongoing expansion of resources for cybersecurity threats. And I think that's a result of both organizations wanting to make sure that they're protected, but also an ever-changing landscape within the cybersecurity market.
I want to talk about the election, Nick. We're only a few weeks out now. How, as a security professional, are you thinking about that event?
Yeah, I think it's an event that sparks a lot of interest from bad actors, and there's certainly opportunity to leverage a bunch of additional venues for bad actors to spread disinformation, to leverage that disinformation or new techniques or avenues for spreading that information to allow individual consumers to do things that they might not otherwise do because of the emotion or the importance of the election itself. And I think we're starting to see some of those trends play themselves out with bad actors leveraging, AI for phishing campaigns or leveraging AI for disinformation, leveraging AI to get content out to individuals. And that content is not only showing up on folks' individual or personal devices, but also, internally to their overall organizations, as they sometimes use the same devices at work as they do at home.
And these bad actors you talk about, Nick, I mean, who broadly are we referring to? Is it criminal gangs? Is it rogue states?
Yeah, in the case of the election, I think, unfortunately, we're dealing with both nation states, but also criminal gangs. And I think at some level, we're also dealing with individuals. So it could be coming from effectively any source. I think during an election year or any time there's an event that has significant interest in the public sphere, you're going to get increased interest and increased activity from the bad actors, both against businesses, but also against individuals. And kind of where those two meet or intersect is also additional risk to individual organizations.
And how has Arctic Wolf, Nick, been involved here in defending against this?
Yeah, so we're a cybersecurity company. We specialize in security operations, and really our goal is to bring the outcomes that you'd expect of a security operation to our customers in a centralized way. And at its core, what I think organizations are looking to do is to ensure that they're protected from threats, to make sure that they understand potential vulnerabilities, that their people are trained, and that they have a plan for incident response. And all of those things are items or outcomes that Arctic Wolf delivers, and we do that on a centralized cloud-native platform for our customers.
And I always like to get your take on this mega trend of AI, how it's evolving. How is it continuing to sort of impact your industry, Nick, both offensively and defensively?
Yeah, it's certainly a trend that's very popular in technology overall. I think in cybersecurity, there's an interesting intersection between its ability to increase the effectiveness of the bad actors by giving them new techniques and new methods to leverage those techniques with or against an organization or an individual. I think on the positive side, cybersecurity companies, Arctic Wolf included, have been leveraging AI to ensure that we're improving our efficiency, improving the effectiveness of our solutions, giving customers an additional avenue to ask questions or further understand individual threats. And I think kind of the marriage or the back and forth of the proactive and defensive mechanisms with AI will continue to persist in cybersecurity, frankly, for the rest of the time that we're fighting these bad actors, which I think will be forever at some level.
Nick, you know, a company, of course, we talk a lot about is OpenAI, the company behind Chat GPT. Do you see threat actors, bad actors leveraging that?
Yeah, there's been reports that have come out from OpenAI themselves saying that they've found bad actors leveraging their technology, and they're leveraging it in ways that I think you would expect. It's a very easy mechanism to be able to write content or produce content that might not be factually accurate, to get that content out in a material way. And then we've also seen bad actors leveraging that technology to do things in a more sophisticated manner, to sequence certain types of events or certain activities that might help with or make, you know, phishing campaigns or other, you know, targeted attacks more effective.
So what do we do about that, Nick? How do we defend against that?
Yeah, I mean, the best thing you can do is start with the basics. So MFA, make sure your humans are trained. We just came out with this human risk report, which stated that, you know, 80% of IT leaders feel that they're protected, yet over 2/3 of them have clicked on a phishing link themselves. So just being aware of your environment, being aware of the situation that we have at hand and what's happening kind of within the overall landscape of cybersecurity is really important. And then make sure that you have, you know, the core components of a security operation addressed: the ability to detect and respond, the ability to understand your vulnerabilities, the ability to train your people and have an incident response plan. And I think if you can do those kind of blocking and tackling, make sure your people are trained and understand the landscape, and then have a security operation to protect your business, you'll be in pretty good shape.
Nick, always great to catch up and have you on the show. Thanks for joining us.
Thanks for having me.
Stocks rebounding in today's trade with the Dow closing at a record high. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. And let's take a look at number one, which is the sector action based today. The leaders were really interest rate sensitive sectors. So I'm saying interest rates rule. And let me just break that down for you. I'm going to go to our heat map sector action for the day. And there's utilities up 2%. Now, we did see the 10-year T-note yield drop a little bit. And so it's not competing with certain sectors like utilities as much for interest rates. So we see this take advantage. Financials also interest rate sensitive, also particularly that's large cap financials, but also on the mid cap size, the regionals. And then we have real estate, another interest rate sensitive sector. And let me show you, Josh, let me show you the 10-year T-note yield because I think the price action is key here. This is a year-to-date chart. Let me put a line here so we can see a little bit. This is a high. We got all the way up to what? 4.6, 4.65, came all the way down here. Then we had a Fed meeting. Then we had a non-farm payroll reports that was hotter in the job market than people expected. And we're just kind of playing around the 4.0% line. So I think that's a bit significant here. Don't want to read too much into it, but that's kind of what's on my mind here.
Utilities, 10-year, but I know you want to talk the greenback. You want to talk the dollar.
I love talking the dollar. And we just did interest rates, so let's talk the dollar as well. Here's the US dollar. Now, unlike interest rates, remember, they kind of inflected down here. US dollar index is still going straight up. And what that indicates is there might be haven flows, or people might just like the higher interest rates on the US dollar. If it's haven flows, you do not want to see that when the Fed is lowering rates, because that means people are scared. So just something to watch, and not necessarily a red warning flag, but something to keep it in the back of our heads here.
All right, Blickery point number two.
All right, Wall Street is feeling bullish. Now, I was just today looking at the Global Fund Manager Survey from B of A, comes out on a monthly basis. This was for October. And let me just show you one of the charts here. There were a number of milestones. And this is the percent ranking of growth expectations and cash levels and equity allocations. Basically, this is sentiment. This goes all the way back to the beginning of the century, year 2001. And here we are. We were right down here for last month, and we jumped all the way up here. And the point of this is that this is a huge jump. And we're seeing a lot of this volatility right now, big changes in allocations, big changes in the way people are thinking about the future, because the Fed is kind of at a knife edge. Not only are we talking, are they going to do 25 or 50 basis point cuts, but are we now facing a no landing scenario? Odds of that are pretty low. I think 14% of the respondents, but it's climbing up. So finally here, just wanted to show you, we also had a record increase in equity allocation, or excuse me, the biggest since 2020, and that was a pandemic summer. And we also had people fleeing out of bonds. That was a record drop in bonds. So all in all, kind of looking a little bit risk on, but frenetic.
So I was going to ask you, is that your signal, okay, everybody in the pool, all in on risk?
I'm going to show you one more thing here, because this happened too. Cash allocations are dropped. So if you're a hedge fund and you are eating into your cash, that means you're bullish because you want to apply that money. And so we just dropped to a critical threshold. We hit it in June, and we actually got, the next month, we got a sell-off in July. And if you had taken that short signal, and the last one before that was just before the pandemic, you would have ended up a little bit ahead. Now we're getting another one. So in the back of my head, this is more of an orange warning. We have equities at record high, but you got to pay attention that we're getting into froth and FOMO land here.
All right, final Blickery point.
All right. Volatility, is it finally a tailwind? I have something here from UBS. This is a derivatives team, and only yesterday the VIX was above 20. It's a little bit down below 20 today. It's not like a magic level, but it is something that we pay attention to, especially when stocks are at record highs, because when stocks are at record highs, you usually see that number quite a bit lower. So here's what they're saying. Here's what they're saying. The last time we saw markets at all-time highs in the VIX over 20 was in 2020. So like the fund manager survey, we're getting back to these comps that are in the middle of the pandemic. So volatility risk premium at highs here. What basically I'm looking for, we are approaching that seasonal time of the year when we see the VIX peaks. I want to see that happen and then see it come down.
Because I remember the Jared Blickery seasonality maps.
You might be in for a treat here. You might be in for a treat. Let's see if I got that updated. Whoa, look at that. All right. So here's a VIX 2024 year to date. That's in purple here. We had that huge spike. This was the biggest increase in one day ever. Then we had a secondary spike and a tertiary. See, this is what happens usually during the year. Here's what happened. What I think might be happening, we might have pulled some of that forward, but if we get a decline going forward, that's going to be very bullish for equities and risk markets. And so that's what I'm kind of looking for. However, that doesn't necessarily come until another week or two. So just keep in mind, this is not precise, but it's been, very useful this year. So keep that in mind.
Be well, Jeremy.
All right.
Thank you, buddy.
Thank you, sir.
Appreciate it. Stick around. More asking for a trend right on the other side. Load of changes in healthcare setting industry players on edge. Rising consolidation, we know, of healthcare providers, surge in AI adoption, and future strains looming over this industry is setting in motion an ambiguous shift in healthcare. Here to discuss, we have Simpler CEO BJ Sheknowski joining us in studio, along with our very own Julie Hyman. BJ, good to see you.
Thanks for having me, guys.
So it's interesting, BJ, high level, what you all argue is, listen, healthcare operations historically, they've been kind of siloed, different people doing different things. And what you say is, listen, we got to simplify this, we got to automate this, and this is where you come in.
Yeah, that's exactly right, Josh. For years, if you think about technology inside of healthcare systems, you've actually seen some of this consolidation. You've seen the Cerners and the Epics consolidate the electronic health record. You've seen companies like Waystar or R1 consolidate revenue cycle management. ERPs like Workday have done the financials. But all the other things that a healthcare system or a hospital has to do to operate, think credentialing a physician, think managing a physician's contract, think compliance, quality, and safety reporting, has been wildly fragmented. And this has really worked against the productivity of critical healthcare workers who should be providing care, not sitting in front of a laptop inputting data. We think we can help fix that.
And so you guys are in place in a lot of different healthcare systems, hospitals, et cetera. Kind of how does it work on the ground? What do you do? I mean, we all have lots of complaints about the healthcare system.
Yeah.
I guess my question would be, how are you making it better?
Yeah, so listen, I just had surgery earlier this year. I had a rotator cuff surgery, right? Old man, these things happen. I spent more time in a hospital and then doing follow-ups than I'd like to remember. And what bothered me the most is that these amazing nurses who were trying to take care of me were spending more of their time checking in, doing some of the paperwork, doing the things I know had nothing to do with providing me care, instead of talking to me about rehab or what I should be eating or doing my diet or stretching. This is pervasive throughout the healthcare system. We have a shortage of healthcare workers. There's about a 30%, a little bit under a 30% shortage of nurses today. And by the way, that's today. Mm-hmm. That's before the boomers age into this next phase of the care they're going to need. We have about a 10, 11% shortage of physicians in this country today. This problem is only going to get worse. We need to make these folks more productive, which means more time focused on care, higher value care, practicing at the top of their licenses, not administrative operational tasks that have to get done, but frankly, they could rely on technology to accomplish those things.
Do you think, though, BJ, as AI kind of evolves here and develops, maybe we don't need as many physicians, nurses, healthcare workers?
No, it's quite the opposite. If you look at the demand equation here, there is no shortage. Now, will AI and the associated technologies, both on the care side and the operational side where we focus, be able to provide real augmentation? We believe so. It's not about fewer workers, it's about the same number of workers doing more high-value work, using that data to make better decisions in the moment. Or for in our use case, right, those nurse leaders. Mm-hmm. Nurse leaders today spend between 3 and 5 hours a day in front of a computer screen. They should be mentoring younger nurses. They should be spending time caring for patients who need them the most. We can actually give them that time back. We've actually done some surveys. We believe through just consolidation of operational software, we can give them back 8 hours of productivity. That's taking a 5-hour day or a 5-day week and actually giving them another day back in their week to provide care. And that's what this is all about.
Now, BJ, one of the other big trends that we've been watching happen in healthcare is private equity investment and consolidation and buying up different healthcare systems. And on the one hand, in some cases, they're keeping the doors open on these systems. On the other hand, they've come under criticism for cutting costs, perhaps decreasing the quality of care. What are you seeing from your perspective? I mean, and I'm sure some of these guys are your clients, so I don't know how much you can say, but what are you seeing?
Yeah, we're in 97 of 100 hospitals in this country, so many of them are our clients. But here's what I would tell you. Healthcare systems have had financial strain, regardless of ownership structure, going way back before the pandemic. That could be private equity owned, that could be for-profit, publicly traded, that could be nonprofit, religious, medical, academic. These folks aren't running at double-digit margins no matter what. So what I would tell you is, regardless of the ownership structure, the real opportunity here is margin improvement, productivity improvement, efficiency gains, leveraging technology. I don't think whether that's a PE buyer or a nonprofit, listen, they all have an opportunity to improve regardless of who owns them. I think we focus there and maybe a little bit less on what the cap table looks like.
BJ, big important topic. Thank you for joining us, helping think through it.
Yeah, thanks guys, appreciate it.
And coming up, we're checking in on a few tickers that are moving after hours. Stick around, much more asking for a trend right on the other side. our chart of the day, we're taking a look at capital spending. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, going into earnings season, and in particular earnings season for some of the big cap tech companies, we are talking about how much they are spending on AI. This was highlighted by the Wall Street Journal today in an interesting chart here that looks at the quarterly outlays on capital expenditures and in particular on what these companies are spending on AI and then what they're projected to be. In particular, we're talking about Microsoft, Amazon, Google, and Meta, the so-called hyperscalers that we refer to a lot. What are they spending on investments in data centers to build out their computing power related to generative AI? The short answer is a lot. The longer answer is the forecast here is for the outlay in the third quarter, to be $60 billion. That is a 56% year-over-year gain. The total projection for the full year, $231 billion. 49% higher than 2023, according to Visible Alpha, as highlighted in the journal. Now, what are the implications of all of this? Well, it means a lot more money going into Nvidia's coffers, as you might imagine, and we have to wait until later in November, likely, to get Nvidia's earnings. They have not yet set the specific date for when they're going to be reporting. There are implications for what we're going to hear from those hyperscalers and what they're going to say in their earnings reports about how much they're spending and how investors to react to that. And then there are implications, obviously, for the bigger ecosystem. Now, it's on that point that we earlier talked to Christy Akulian of BlackRock about how they're thinking about where to invest.
We're looking at the AI trade broadening out too. So something that we've been talking about since the mid-year. I know you highlighted it as one of the top performers and kind of hitting an all-time high, but we like utilities as another way to play. We like data centers as another way to kind of get ahead of where that AI trade is going next, not just where it's been really successful so far.
So another bull in the utilities column is another way to continue to play this. But obviously, judging by these big numbers, it's not going anywhere, Josh.
Thank you, Julie. Let's take a look at what's trending after hours. Lucid shares sliding as the company announces a public offering. The electric vehicle maker is set to offer more than 260 million shares. The company also announcing preliminary third quarter results. Revenue coming in at $199 million. That was above expectations, but it is still losing money, reporting an operating loss of up to $790,000. Now, taking a look at shares of Kinder Morgan, the energy infrastructure company, delivering a miss on the top and bottom lines for the third quarter. Kinder Morgan noting contributions from the products pipelines business segment declining compared to last year. Company citing that decline in part to lower commodity prices. Kinder Morgan, however, reaffirming its full-year guidance. And now, next up is Alcoa, the aluminum producer, moving higher. It's after swinging to a profit in the third quarter. Results beating estimates on the bottom line handily. Revenue missed expectations. The company also revealing it's progressing toward a strategic cooperation agreement with Spanish renewable energy company IXIC. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern. Have a great night.